When a traditional bank says no to a buyer, what are the actual alternatives?
So when it comes to non-traditional financing, there are four main types of loans. There's the bank statement loan, the investor loan, or what they call DSCR, debt service coverage ratio loan, 1099 loans, and loans for foreign nationals. Each one serves a different type of buyer, and the most people have been told no by bank qualify for at least one of them.
Non-QM loans, non-qualified mortgages. This term gets thrown around, but most buyers don't really understand what it means. Can you start there?
Sure. A qualified mortgage, or QM, is a loan that meets specific government or GSE guidelines like Fannie and Freddie around income documentation, debt-to-income ratios, and loan features. All conventional loans are qualified mortgages. A non-QM loan is simply a loan that falls outside of those specific guidelines in one way or another. It's not a worse loan. It's not riskier. It's just built differently. And it's built to serve buyers who don't fit the standard mold. And the buyers who don't fit the standard mold are a huge and growing segment. Self-employed people, investors, foreign nationals, anyone with complex income, even folks who just nearly miss the conventional guidelines. For all of them, non-QM is often the most practical and sometimes the only path to ownership.
What's the biggest misconception people have about non-QM loans?
The biggest misconception people have about non-QM loans is that they're the loans from 2006 that helped cause the financial crisis. They're not. The non-QM loans that contributed to the 2008 collapse were no documentation loans with teaser rates that reset dramatically, products that were fundamentally designed to be unrepayable. That world no longer exists. Today's non-QM loans are fully underwritten. Lenders verify income just using different methods. They verify assets. They run credit checks. They analyze ability to repay. The difference is the documentation method, not the underwriting rigor. A bank statement loan is underwritten just as carefully as a conventional loan. The question is just, which documentations prove the income?
Walk us through the four main non-QM programs. Who is each one for?
So to walk you through the four key non-QM programs, the first one is a bank statement loans. They're for self-employed buyers and business owners. Income is documented through 12 to 24 months of personal or business bank statements. And this is best for people whose tax returns understate their real income. Number two is DSCR loans, or debt service coverage ratio, for real estate investors. The property qualifies based on its rental income, not the buyer's personal income. No W-2 required, no tax return. The question is simply, does the rent cover the mortgage? 1099 loans are really for independent contractors and gig economy workers. Income is calculated through 1099 forms and sometimes bank statements, a middle path between the W-2 world and full bank statement loans. And number four, foreign national programs are for buyers who are not U.S. citizens or permanent residents. These require specific documentation such as passports, visa, international credit history, but they exist and they work. Each program has different down payment requirements, rate structures, and credit requirements. The right one depends entirely on your specific situation.
Can you give me an example of someone who came to you not knowing which of these applied to them and how you figured it out?
Yeah, so most people come to me don't really know the programs, and our job is to figure it out based on their situation. So I had a client who came to me completely overwhelmed. She was a freelance consultant, so she had 1099 income. She also owned a small rental property, and she was buying a new primary home. She'd been to two lenders, and one tried to qualify her 1099 income alone, and the numbers didn't work. The other told her she might need to sell the rental first to clean up her debt-to-income ratio. When I looked at the full picture, neither of those was the right approach. We used a bank statement loan for the primary home. Her consulting revenue was strong and consistent. The rental property was already cash flowing, so it actually helped her DTI rather than hurting it. She closed on the new primary home without touching the rental. Total timeline, 34 days. And the lesson? Non-QM isn't just about picking the easiest path. It's about finding the right structure for the complete financial picture. Two lenders look at parts of their situation. We looked at all of it.
What determines which non-QM program is right for a specific buyer?
Well, there's three things that determine what's right for a non-QM buyer: how their income flows, what they're buying, and their timeline. Income flow is the primary driver. If you're a business owner with strong deposits, that's bank statement. If you're buying a rental and the math works on the property's rental income, that's DSCR. If you're a contractor with clean 1099 forms, that might be the simplest path. What you're buying matters too. Your primary home and an investment property are underwritten differently. So sometimes the right answer is one program for one property and a different program for the next. And the timeline matters. If you're under contract and need to close in 21 days, that might narrow your options as well. If you're 30 plus days out, we have more flexibility to structure the optimal solution. The right answer usually takes one conversation to figure out. It's not complicated, it just requires someone who knows all the programs and can match them to their situation.
What's the mistake people make that costs them the most in this process?
It's accepting the first no without asking what would make it a yes. When a lender declines a file, the answer is almost never, this buyer can't get a mortgage. The answer is the file doesn't work with this documentation method at this lender. Those are completely different statements. One closes the door, but the other opens a conversation. I've approved buyers who've had 3 prior declines, not because I'm a better lender than the people who said no, but because I asked different questions and found different structures. If you've been turned down for a mortgage, the first question you should ask is, which loan program did you try? Because there are many others.
For someone who has been declined or isn't sure if they can qualify, what do they do right now?
For someone who's uncertain that they qualify, there's 3 things I would do. First, get a copy of your decline letter so you have one. It will say why you were declined, and that tells me exactly which program to explore instead. Second, pull your last 12 months bank statements. Even if you don't know which program applies, this document is useful for almost every non-QM path. And third, call me before you apply anywhere else. A 20-minute conversation is usually enough to tell you which program fits your situation and what the numbers look like.
And if they want to explore their options with you?
So if they want to explore their options with me, I would say take the home loan quiz on my website. There's a specific path for non-QM situations. I'll review your answers personally and come back with a recommendation. Or reach out directly. If you've been told no before, that's exactly the situation I'm built for.